Everyone thinks they know how the stock market was saved. They've been told it was bravery, smart policy, decisive leadership. That story is comforting. It's also wrong. Because the market wasn't saved by truth. It was saved by a lie so carefully constructed that questioning it would have collapsed everything. To understand this, you have to go back to the moment when the system quietly stopped working. Picture this. Screens glowing red across the world. Banks staring at numbers they didn't fully understand. Phones ringing non-stop. Institutions that had existed for over a century were suddenly unsure if they would survive the week. Money was supposed to move freely between banks every night. That's how modern finance breathes. But then, one night, it didn't. Banks stopped trusting each other. Not because of rumors, not because of fear, but because they had looked at their own balance sheets and realized something terrifying. They didn't know what their assets were actually worth. For years, financial institutions had been packaging debt, slicing it, renaming it, and selling it as something safe. On paper, it looked brilliant. Risk was diversified. Returns were steady. Everyone was getting rich. But in reality, these assets only worked as long as no one tried to sell them all at once. And then people did. Suddenly, assets that were supposed to be rock solid had no buyers, no price, no market, which meant banks weren't just illiquid. They were insolvent. This is the part most people never hear. When a bank says it's fine, it doesn't mean it has money. It means people believe it has money. And belief was evaporating fast. The public story blames panic. It blames emotional investors. It blames people for overreacting. But panic is an effect, not a cause. The real trigger was simpler and far more dangerous. The system discovered it had been lying to itself. Behind closed doors, executives weren't asking how to calm markets. They were asking how long they had before everything collapsed. They knew that if the public understood how fragile things really were, there would be no recovery. There would be a run on everything. Banks, funds, governments. So emergency meetings began. Not about fixing the system, there wasn't time for that, but about stabilizing belief. Here's the uncomfortable truth. Markets don't run on numbers. They run on confidence. You can survive losses. You can survive debt. You can even survive corruption. What you cannot survive is everyone realizing it at the same time. And then came the moment that changed modern finance forever. A decision had to be made. Tell the truth, accept the collapse, and rebuild from the ruins. Or create an illusion strong enough to carry the system forward. They chose the illusion. Trillions of dollars were created with a keystroke, not earned, not saved, created. But that alone wasn't enough. The real lie wasn't the money, it was the message. Officials went on television and said the system was sound, that banks were healthy, that the worst was over. Behind the scenes, they knew that wasn't true. What they were really saying was, please believe this. Because if you don't, we're finished. And it worked. Markets didn't recover because the problems were solved. They recovered because doubt was delayed. Think of it like a collapsing building held up by scaffolding. From the outside it looks stable. From the inside it's already broken. Confidence returned. Stocks rallied. Headlines declared victory. But the system that emerged was not the same one that collapsed. It was something else entirely. Central banks learned a dangerous lesson. They could override reality if they acted fast enough. Risk stopped being punished. Failure stopped being final. Institutions that should have disappeared were preserved. Not because they were innocent, but because they were too connected to fail. Losses were socialized. Gains remained private. And slowly, quietly, the cost was passed on. Not in one dramatic moment, but through inflation, through housing prices, through stagnant wages, through debt that never seems to shrink. Most people never felt the crisis directly. They felt it later when life became more expensive and explanations became more confusing. This is why modern markets feel disconnected from reality, because they are. Prices no longer reflect value. They reflect expectations of intervention. Investors don't ask, is this company healthy? They ask, will someone step in if it fails? And that changes everything. Crashes are no longer endings. They are pauses. Moments where confidence drops just long enough to justify another rescue. Each time the lie grows bigger. Each time the system becomes more fragile. And here's the part that should really disturb you. The people who made these decisions weren't evil masterminds. They were afraid. Afraid of being remembered as the ones who let it collapse. Afraid of choosing truth over stability, so they postponed consequences. But postponed consequences don't disappear. They compound. That's why today's markets feel unnatural. Why bad news is good news. Why debt is treated as growth. Why bubbles are called innovation. We are living inside the aftershock of that lie. A system kept alive not by strength, but by belief that it will always be rescued, until one day it isn't. Because there is a limit to confidence, and no one knows where it is. Not analysts, not governments, not central banks. They only know one thing. When belief finally breaks, it won't look like a normal crash. There won't be time to explain it away. There won't be comforting press conferences. There will just be silence, and then chaos. Financial crises aren't random. They follow a script. Overconfidence, leverage, complexity, denial, intervention, and finally, the lie that holds it all together. The stock market wasn't saved, it was suspended, and someday gravity will return. Thanks for watching. If this made you think, consider subscribing for more content like this. Stay curious.